Thank you for the introduction. Thank you for the invitation. I'm happy to be here. Though I'm normally not that concerned about getting my qualifications right, I must, in this case, make a slight correction that I also got an MBA in finance from the MIT Sloan School of Management, only because that is going to be the basis on which I'm doing a lot of my talking now. These are not concepts that I learned by accident, but were taught to me by some brilliant professors at a great school. So let me start by saying that I'm very vested in this notion of growing the debt markets. As a former investment banker who worked in the debt space, I say what you all know, that in any kind of normal economy, the debt market should be substantially bigger than the equity market. The debt markets are the one that provide the basis for almost all the actuarial and insurance kind of asset management, which forms the bulk of people's need to move money back and forth in time, and which forms the basis, the underpinnings of the whole financial markets, really. So in that sense, having spent a lot of time in the US, where about 80% of all corporate debt comes out of the markets, and where the debt market is so efficient that even the front end, the money markets end, the less than 9 month, in fact, average age 1 week or 10-day market is worth trillions of dollars. I see the huge, what can I say, burden on India of trying to grow without having an active debt market. Of course, some of these problems are structural. Debt investors are by nature pessimists. Their upside is capped. They've sold somebody a put. And so what they would like is clarity of what happens when things go bad. It's not so much how great things can be, but how quickly can you get resolution? What would be the estimated recovery after some kind of bad outcome? And in that sense, our country is very ill-equipped because either the legal precedent or the judicial system is dispute resolution mechanism is not that great. So I completely believe that tech is the only way we can scale these debt markets in the reasonable future. And so I'm very excited that such conferences happen. And with the new technologies, the breakthrough technologies in tokens and blockchain that can remove some of the limitations of KYC, then I think we are at the right inflection point for that kind of growth. But let me now go back to the topic that was actually given to me, which is Tamil Nadu's plans for investment and infrastructure and our contribution towards getting to the 1 trillion that our Chief Minister has said as part of the broader ambition of the Prime Minister for several trillion for India. So really, let me talk about three components. The first component is the government itself. As you know, under the FRBM Act and equivalents, the two major recommendations or guidelines, I would say, because they're written into the law, is to have a zero revenue deficit and up to 3% fiscal deficit, which basically implies that you don't do kind of spending more than you earn, and then you borrow up to 3% of your GDP or GSDP, union or state, and use that to do capital investments. Now, why 3%? Because effectively, you don't want the coupon payments, the interest payments to rise too fast, because infrastructure projects take some time to come online. Now, in retrospect, those guidelines worked really well. A place like Tamil Nadu, the debt to GDP ratio dropped from somewhere around 28% down to 16% between 2003, the adoption of the FRBM, FRA Acts, and let's say 2014. The interest to revenue ratio dropped from something like 21, 22% down to about 11, 12%, which meant that the government had real capacity to do capital investments and kind of support growth. Governments have a huge role to play in terms of infrastructure investments to support growth, because if you really think about it, governments borrowing and investing in things like roads and ports and bridges and hospitals and drinking water systems are the lowest risk is the government itself executing. The lowest cost of borrowing, the sovereign is borrowing, and with the highest multiplier effect relative to private enterprises that are looking for shorter term, lower risk returns. So in every way, the government expanding its capex is a big boost to the economy and the growth rate. And the real tragedy of the last 5-7 years for Tamil Nadu has been that because of soaring revenue deficits, we have gone down from 3% of GSDP down to more like 1.5% 2 years ago. Some of that is being reversed by the pandemic. A lot of that is being reversed by better fiscal management. And our budget showed a medium-term fiscal plan where we'd get to pretty close to revenue neutral by the year 24-25. That is 2 years from now, after already having cut the fiscal deficit by more than 1% last year when the final account will be out. So the first thing we can do is make sure that we run the fisc properly and we borrow and invest up to 3% of GSDP. Now think about what that means. Last year, we struggled because of the pandemic, because of the crushing debt load, because of the legacy, the debt hangover. We were only able to invest about 35,000 crores. If we do our job right and if we meet the standard that I have set for ourselves, in 2024-25, we will be investing more like 90,000 crores, 95,000 crores, 3% of what will then be a 30 lakh crore economy. So that should have a huge multiplier effect for all the reasons I said. And moving to the second part, it is our approach in these things, much like our predecessor, though she never got to execute it. We would like to do as much as possible co-investment from the private sector. So in the Vision 2023 document she had laid out, she had a target of 1.5% off balance sheet, meaning PPP or other kinds of through the Tamil Nadu Infrastructure Fund Management Corporation, an alternate investment fund manager that we have set up to do parallel investments. We are definitely going to pursue that as well. So it is our ambition that by the year 24-25, which is 2 years from now, we should be about 45,000 crores, so about 1.5% of GSDP in off-balance sheet, either PPP directly or through the fund management companies' funds in tourism, in startups, in housing, in infrastructure, and with co-investments on that. So effectively what we're talking about is a quadrupling from 35,000 crores last year to about 140,000 crores in 24-25, 2/3 of which will be the government itself, and a third of it will be co-investors or PPP or other models that I said. So I think these two things will greatly help us drive the growth. Last year, we grew at about 9-point-something% real and about 14-and-something% nominal. This year, we're slated for those targets both this year and next year. For us to reach our 1 trillion goal in the remaining 8 years, partly because of the setback in the rupee, that goal has become more ambitious than it used to be a year ago. But at this level of the rupee, and assuming that inflation is contained at the 6% upper bound of the RBI's 4 to 6% range, then really what we need is 10 or 10.5% real growth. We only got about 9 and something last year. So it again behooves us to ramp up, but we got 9.5 to be fair, with less than 2% of the GSDP in capital investment. So we feel that were we to get, and some of that, of course, is the low base effect recovering from the pandemic. But when we get to steady state, our ambition is to have 4.5% of GSDP as capex, and in conjunction with the fact that that will bring in private players and people who are here for the return, then we think that we will be able to accelerate the real growth north of 10%, which we achieved actually when the DMK government was in power in 2006-11. The RBI statistics show that we had real growth of 10.15% CAGR for 5 years, despite having to go through the global financial crisis and some other setbacks. There's a third component to it, which is not strictly in our domain, but which we are going to actively support innovators and the kinds of people who are at this conference, which is that we really have to improve the availability of credit and capital to the MSME sector and to individuals. In a country like India, for various reasons, right now there's almost zero unsecured credit available for individuals and limited unsecured credit available for MSMEs. Now, some of that is changing through incentive programs at the union level, at the state level. Some of that needs to improve a lot more using the latest technologies. I was recently in both Australia and Singapore, and in both countries, I was very impressed to see how using blockchain and token and cross-validation, the government of some of the states in Australia are moving to even something like a driver's license, basically as an e-driver's license with a token from the government on your phone. And during the pandemic, they used the crisis and the need for remote validations to move up and move a lot of things into that kind of e-wallet. They're now moving in some cases to putting your educational certifications, your credentials, etc., into a cross-validated blockchain wallet where you can use that, wherever you go for an interview or something. So that's a great learning example for us, and we'd like to replicate that. I was also, as I said, in Singapore, where the gentleman in charge of the fintech for the MAS, which I had done some work for when I was in Singapore with Stanchart, has come up with a very innovative way of MSMEs, to start with the micro and small enterprises, cross-validating each other through their transactions and through their accounts payable, accounts receivable, etc., as a way of building up credit history that can then be accessed by the banks, and to use that as a means of funding. As the finance minister, I've also taken active interest in the what we call the state level bankers committee, which is the kind of gathering of all banks that do business in the state. I have made it my priority to attend every quarterly meeting to ensure that meetings are held quarterly. And in those, we talk about a lot of these things, about using different methods and ensuring the flow of credit to the places where it's needed most desperately and where there is no hope of accessing the market, but usually goes through the banks. Eventually, I'm sure technologies like those that who are participating in this conference will perfect. There will be a market-based access to credit as well, which eventually is the only kind of long-term solution. I think I may have covered everything that I was asked to cover. I will just say two things, maybe as I finish. When I was at Stanchart, we had a rule of thumb, at least in the emerging economies. If the economy was slated to grow at X%, we assumed the credit would grow at 2X%, because these are all capital, short, capital deprived countries, for the most part, except those that are now booming through commodities, let's say. And so, the need for credit would be very high indeed. So we can use that as well as a rule of thumb. And if we say that we're expecting, 10, 12%, or 10% real and 15%, 16% notional, we should expect bank credit to grow 20, 30%, or market plus bank credit. And that's where I think a lot of these technologies come in. The other thing I would say is that a lot of this has to do also with execution. While we design things, while we plan things, especially in the government, we find that the penetration of the message, the penetration of the program, the penetration of the subsidy, the awareness of the possibilities is less than it should be. And therefore, people are not getting the intended benefits that the government policy set out to achieve. And so some of this also could be supported by better technology and better dissemination. And I think that would be a good thing as well. That would come out of something like the innovation that all of you in this conference are participating. With that, let me conclude my remarks. I don't know if there's any room for Q&A, but otherwise, thank you again for the opportunity, and I wish you all the best for a successful conference and impact in growing the debt market. Thank you.